In this presentation, we will take a look at responsibility accounting and performance measurement. This will be a long presentation, so if you would like to jump to relevant points within it or take a look at a playlist which will have this information, take a look at the description below, which will provide links to those areas as well as the description of what will be included at those links. In this presentation, we will discuss a responsibility accounting system. When considering a responsibility accounting system, we are imagining our organization. We are decentralizing our organization. We're putting different managers in charge of different segments, different areas of that organization, giving them more responsibility. As we do so, we're going to assign the responsibility to particular managers, and we're going to hold them accountable for different items, those items being the controllable items. So we're going to assign what is going to be a controllable cost versus an uncontrollable cost by the responsibility units, by the managers, to the managers that are in charge of those units, of those segments, of those divisions of the organization. Remember that a controllable cost is one a manager has the power to determine or at least significantly affect the amount incurred. So we're thinking about those costs where management has control over them. Even if a cost is assigned to a specific area or division or is used by that division, if the department manager within the division isn't having control over it, then we don't want to use it as a performance measure of the performance of that particular manager. We're going to use it for other types of decision-making purposes for that particular unit, for that particular segment. But when evaluating the performance of a manager, the responsibility of a manager, we only want to include those costs which are controllable, those things that they have some power to do something about. An organizational chart is going to be a very useful tool and a necessary tool for responsibility accounting, because remember what our objective here is: to take the organization. It's going to be to break them up into separate units, separate segments, and then assign responsibility to that. In order for this to work well, we need to know exactly what those units are so that we can assign specific responsibilities. What we don't want to have happen, therefore, is to have some types of things that are important responsibilities that are not assigned. No one has been assigned the responsibility over them. The only way to really cover that is to have a pretty specific organizational chart, have very defined and specific roles that are going to be assigned to different units within the organization, and then have appropriate measures that we can assign for our objectives and the measurement of the performance of whether those objectives have been met by the departments. When considering the responsibility accounting reporting, we can see that the lower levels are going to have less controllable costs. Obviously, the plant managers here at the department level will have the controllable costs of their plant, of their department. They will then be reporting to the vice president of the region, and the region, in essence, has to have controllable costs, which include the plant manager costs, and so on and so forth as we go up through the hierarchy, through the chain here. Note, however, that if we look at the plant manager level, they're going to have more detailed reports about what they have control over. They're on the floor, they're on that ground level. We want detailed reports about that management, what they have control over, so that they can make the appropriate decisions here. As we move those costs, those controllable costs that are under the vice president, they may have less detail from a department by department level that will then move up to the vice president level. However, of course, the amount of costs, controllable costs, that are going to be under the umbrella of the vice president will increase. So in other words, on the department level, more detail of the reports, the types of costs that are being controlled, but there are fewer controllable costs. As we go up the line, there's going to be less detail of the types of costs. However, there's going to be more amount of controllable costs as we go up the chain. So if we imagine this situation, we have the report on the store level, let's say. We have a very detailed report of the controllable costs of the store. If we think about the regional manager here, the vice president of the region, then this report is going to be summarized as we go to the vice president, because they don't need as much detail. They're not on the ground level controlling the controllable costs. That's going to be the job of the manager of the store. So here we can see that there's going to be a lot more controllable cost is going to be a lot more detail, a lot more information, but it's going to be less detailed than the information on the store level. The store level, in other words, is going to have a lot of detail about the costs they have control over, summarize those, give them to the regional office. The regional office has less detail for each store, each place, but of course is in charge of ultimately more controllable costs as they are in charge of multiple regions. So if we consider just how this cost structure could work, if we consider an executive vice president of operations, these being the controllable costs, this is at the higher level now. We're talking about the higher level, the executive vice president of operations. We got the controllable costs, the salaries for the VPs, the quality control costs, the office cost, the East region, the West region. Then we can break out the East region. Who's going to be in charge of the East region? This is the vice president. It's going to be held accountable for the East region, where we have the controllable costs, including the salaries of the department managers, not the salary of the vice president, because that's not something they control. That's going to be controlled up here, right? But they have the salaries of the department managers, the depreciation, the insurance. We have the department 1, 2, and 3, and then the totals here, of course, are included in the line item in the executive vice president operations. So we can see up here in this report, on the upper level of our hierarchy, the executive vice president has more controllable costs, is overseeing more costs, of course, but has less detail than we see down here on the vice president of the regional office. The totals then being our line item here. So our line item within the executive vice president operations report then is broken out to the detail in the vice president for the East region report. And of course, those totals add up there. And then if we drill down into the Department 1, then we would then have the plant manager for Department 1. Again, here's the summary information for the higher up level, the vice president of the East region. Here's the plant manager level, where we have now the detail of that Department 1. They got the direct materials, the direct labor, the overhead, the totals then here. So the more detailed report then being on the lower level, and then it being summarized up at the higher level. Now we might want to see this in reverse. It might be easier to see this in reverse if we go from the bottom up. So we go from the lower level up. Here's where we start with the lower level. And you might imagine this is how the actual reporting would happen, because we would have to gather these things together at the lower level and then summarize them. So we start from so we go from like kind of a bottom up type of structure as we put these things together, possibly. So we have the plant management department 1. So this is the lower level. We could think of like the department level, the store level. We have the direct materials, the labor, the overhead, and then those totals are going to be included in the report that goes to the vice president for the region. So this report, if we were then the Department 1, we report here and say, here's our report. This is our summary information. The vice president for the East region has the report that shows that in summary, as well as the other departments that they're in charge of, and then the other costs that they have control over, the salaries for the department management, depreciation, and insurance. And then if we go the level up, here's our totals. We've got the vice president for the East region, and that's going to total up to, as we go up to the executive vice president of operations. So now we've got the East and the West. So if we were then in charge of the East, we would have our detailed report, sum that up. That's going to be part of the reporting to the executive vice president of operations, as well as the West. The salaries and VPs and the quality control costs and the office costs are going to be included as controllable costs for the executive vice president of operations. So if you see it all in one, you can see this is from top to bottom or bottom to top. You might want to think about it at either way. Again, it sometimes might be easier to think about it from the bottom level. Here's the store. We put our stuff together, summarize it. It's going to go up included here. Same process would happen for Department 2 and Department 3. And then we're going to sum up the detail that's in control of the vice president of the East region. And those totals will then be included at the next level up in the executive vice president of operations. We see the detail down here. It's one line item on the report for the executive vice president of operations. In this presentation, we will discuss the concept of decentralization. Decentralization being a core component to responsibility accounting. So what is decentralization? I like to think of it in this format. We can think of it as the size of the company and the scale of the decentralization that will follow with the size of the company. In other words, When we think of a small business, then typically we think of an owner of the small business, and the owner of that small business will be involved in much of the day-to-day operations of that small business. As the business grows, then the owner is going to want to take themselves out of some of the day-to-day operations and decentralize, give that responsibility to others so that the owner can focus more on the big picture goals rather than on the day-to-day goals. And of course, as this continues to happen, as a company gets larger and larger, there becomes more and more of a need to have some decentralization and give more responsibility to other departments within a company. So if we're talking about a large company, companies are divided into smaller units, possibly called divisions or segments. In this presentation, we will discuss the concept of decentralization, decentralization being core to responsibility accounting. So what is decentralization? I like to think about this by thinking about different sizes of an organization and imagining an organization growing from a sole proprietor to a large corporation. If we're a sole proprietor, then we know that the owner of that sole proprietor is going to be involved in many of the day-to-day decisions within that organization. As the business grows, then there's going to be a lot more delegation of those decisions to other people so the owner can put their time in the most value-added way to the business, while some of the day-to-day type of activities are then delegated some other place. Of course, as companies get larger and larger, this needs to happen more and more. And so with larger organizations, as companies get to a certain size, the company is going to have to delegate the decision-making to different segments, different units, different divisions. And as they do so, these different divisions are going to have more and more say, more and more control over what happens on the divisional level. That allows the manager to basically, and the top level management, to be more focused on the things that they need to be more focused on, typically the longer overarching type of vision. So just realize when you think about this decentralization kind of concept, it's out of necessity that we have the decentralization. In other words, as things get larger, we typically need to have more decentralization in order for things to run well, in order for things to run smoothly, because we can't run things as efficiently simply from a top-down approach. We have to decentralize and give more authority as things get larger to different segments, to different regions, in order to be the most efficient typically. And the way this decentralization will typically work is as a company gets larger, we can decentralize by region. We could say, here's the different areas that we have. We're going to decentralize by those regions, and we're going to put specific individuals in charge of managing those specific regions, and therefore be able to give responsibility and measure the performance of those individuals by those regions. Or decentralization through the product line. So different products that the company produces, we can segment out the company by those different products and put managers in charge of those different product lines. Again, being able to give more responsibility to those managers and hold them accountable, be able to measure their performance. When we consider the concept of decentralization, there's going to be benefits and there's going to be drawbacks to it. So we'll discuss both the pros and cons of them. In other words, each organization is going to have to decide how much hierarchy they're going to want, how much control is going to be in the central office versus some type of decentralized format. And there's pros and cons to either format. Some companies will be more centralized, much more the decision making possibly made from the central office. And some companies may be much more decentralized. And it could depend on the type of organization, the types of companies that might work better, or just the culture and the structure of different organizations as to which organizations might be more or less centralized. However, as companies get larger, there will be need typically for more decentralization so that the company has the ability to grow. But within the size of each company, there's going to be variances from company to company in terms of how the company will decentralize and how much decentralization there will be. So what are going to be the benefits, the advantages of decentralization? One is that if you think about the regional managers, the people that are going to be involved in certain areas or certain product lines, they're going to have more timely access to information in a decentralized system. Why? Because they're on the ground and they don't have to wait for basically the processing of information. You can imagine a situation where everything has to process through the central office. If that's the case, if all the big decisions or even like the day-to-day type decisions of a regional office have to go to the central office and then be processed, decision be made on it that then is dictated to the managers of the regional offices, it becomes a little bit slower. That's one of the problems with a centralized process. The central office doesn't have the means to deal with many of the day-to-day type processes in the regional areas, at least not efficiently or as quickly. If you're able to get managers that can see the overarching vision, apply the overarching vision on the department by department level, then they can see what's going on and get that information a lot more timely in the area that they are in, and hopefully take the relevant action necessary to do so. In order to do that, however, you need to have good managers that are on the ground that can basically make the decisions within the framework of the overarching business vision, as well as gather the appropriate information. If that is the case, however, then it could be more timely information to make quick decisions in a more decentralized area. Allows top management to focus on the big picture. And that's going to be one of the major benefits, of course, because the top management, it's just like when a small business starts to delegate out the responsibilities. It's delegating out responsibilities not because they're not important. They are important. These are the day-to-day activities that need to happen in order, there's the lifeblood of the business. They need to happen. But what we need to do from the owner's perspective is think about the long-term vision, the long-term map. And that's more and more where the vision of the owner of an organization tends to want to be. It needs to be in order to have that long-term vision so that the day-to-day activities can then be guided to and line up with the long-term vision. The same is true for a large organization. If you think about the central office doesn't need to be, if we can have less of the day-to-day activities or the regional activities that happen on a day-to-day basis to be needed to involve the central office can then do what they are expected to do or should be doing, and that's going to be guiding the long-term map, the long-term plan. That's where they want to spend their time, delegating much of the day-to-day type of activities, the regional activities, the lifeblood activities, the things that really run the company on a day-to-day basis, to regional, divisional areas, and being managed by those areas. If they can trust the management of the day-to-day activities to be run well there, then that system can work good, because the top level management then is freed up, just like a small owner is freed up if they delegate their responsibilities to then the larger or bigger picture type of activities. It can provide training for employees. When we think about larger organizations, part of the purpose of a company, part of the objective of the management of the companies is, of course, to act as agents of the shareholders who are the owners of the company. And part of that is to develop good leadership within the company. And the only way to do that is really to delegate responsibility. So if we have more decentralization, in other words, we are able to allow regional managers to have the ability to make the decision-making processes. They're going to make mistakes, but they also could improve the process as well and develop within that process and possibly develop into top-level management. In other words, it's best within an organization if we can grow management within the organization and be able to replace the management. There should be no one person within a large organization that is the whole organization is dependent on, even the top level management. And so to have more decentralized areas, you got a lot more kind of training ground, testing ground with decision-making skills with people in those regional areas that can then learn, grow, possibly then take over the top level decisions as well. The less centralized you have something, then you have a lot of people within the division that are really good at kind of following orders. And that's good too, that you need that in some areas as well, but it's not going to be as transferable to the decision-making process, to the top level management, where you're trying to develop someone who's going to be able to make the decisions and not just follow what needs to be happening. So you want to give more delegation of the authorities to apply the overall principles of the company within a region. And then that allows people to kind of have more flexibility to make their own decisions within that overarching framework, rather than having very stringent kind of rules, because that takes another type of discipline to basically run the day-to-day type of activities. You need more of a kind of discipline on that format. So that's one of the advantages of decentralization: increased employee morale and retention. Oftentimes when people have more decision-making skills, more control over what they are doing, it increases their morale. They feel more value. In other words, if you're told what to do, and even if it's the right thing to do, and you just basically do what you are told, then the fact that it's right or wrong doesn't matter as much to you. It doesn't register as much as if you have the control yourself to basically say, this is in alignment with what I think the company objectives are, what we're trying to do here, and therefore we're going to make decisions to achieve that goal. That's going to give people more motivation most of the time. If you say, hey, this is our goal, this is our alignment, we'd like to get your input in order to help us to achieve that goal, that really is an internal motivation, and that can motivate people as much as pay, oftentimes, depending on the type of individuals we're dealing with. And so that's one of the major benefits of a decentralized system. You're able to give people that flexibility to make those decisions, and you're developing the type of people that are internally motivated rather than externally motivated. If you're dealing with a situation that's very hierarchical and you're basically just telling people what to do and saying, do this in accordance with the way we need it to be done, you're probably developing more people that are going to be really good at obeying the rules and might be motivated externally by the compensation, but may not be developing so much of that internal motivation, which is really there by being involved in the decision making and feeling like you have a kind of a difference in terms of your input into the decision making process. So what are some disadvantages of decentralization? One is that it could lead to divisional managers being too focused on local goals rather than the big picture, the big vision of the company, and therefore do things that would be harmful to the overall vision of the company in order to achieve local goals. In other words, it's possible, and we can think of the structure of the organization as top-level management, thinking about the vision of the organization. What's the overarching vision of the organization? Breaking that down, then setting responsibility goals for each department. But as we do so, each department knows that they're going to be measured on the goals that are set for that department. They're not measured on how much they're contributing to the overarching vision necessarily. In other words, these goals are set in order to, of course, achieve the overarching vision, but we don't want things to happen so that people try to achieve the goals and do things that would be harmful to the overarching vision. That's a danger that could happen. And in order to deal with that problem, we have to have some type of culture within the organization to be able to say, hey, these are the goals, these are the objectives, this is our overarching vision, and hopefully the management that we have in place will see the overarching vision and take actions that are in alignment with the overarching vision, even if they do not line up with the short-term goals or could harm the short-term goals, and basically be able to communicate that and why those decisions were made possibly with upper management when that is the case. Then we have the conflict between departments. Oftentimes when we think about the decentralization, there can be competition between the departments or a lack of communication. In other words, if you have a top-down type of structure, everything goes from the corporate office and then is communicated to the rest of the organization. It's very clear what the chain of command is, what the line is, where the information, the decision has come from, and how that decision will then be disseminated through the rest of the organization. When you have decentralization, then you've got different regional departments that might have conflicting goals, and they might actually be in competition in some ways with each other as they're trying to reach their goals, because that's going to be part of the motivational structure of a decentralized system oftentimes. If that is the case, if it gets to the point where there's a conflict of interest, where the tension between departments is not helping to stimulate the departments to work more, but is in fact causing problems that are going to limit the overarching vision and achievement of the organization, then that can be causing a problem as well. And again, the way to basically reduce that is to have the culture of the organization be such that although there's going to be competition within the departments, with the overarching vision is going to be the overarching goal of the organization, to hopefully have the management that is in alignment with that overarching vision and is achieving the short-term goals within that. And of course, a key to that is communication between the departments, communication with management with regards to those issues and any kind of conflicts that could come up within them. Possible unnecessary duplication of activities. So as we decentralize, it could be the case that you have two different departments that are basically repeating activities that could be done in one area. So in other words, if you had one centralized area that was run by the corporate office, decisions being made and then dictated throughout the company, then those type of activities that are going to be necessary for multiple departments would then be dictated and be made in accordance with that hierarchical structure. However, if you have different departments making different decisions, it's quite possible that those different departments duplicate type of processes that may be able to be done in a centralized format. And that duplication, of course, will cause waste and inefficiency. So we want to be able to be vigilant of any kind of duplicated process, see if it's possible for us to say, hey, can we have some type of service department that would basically do this process and then divvy that up or allocate those costs to the divisions. In this presentation, we will discuss performance evaluation and department classifications. When considering responsibility accounting, we're thinking about the decentralization of an organization, the decentralization giving more control into the regional areas, into the regional or department managers for decision-making processes. As we do that then, in order to be efficient, we want to be able to evaluate the performance. And in order to evaluate the performance, we're going to need to know the classifications or the type of department, the type of unit that we're talking about so that we can set the appropriate standards. So the performance evaluation goals, what's the goals or objectives of evaluating the performance of different segments? We want to be able to control the operations of those sections. We want to be able to appraise performance. And you can obviously consider this idea that we have managers that are going to be involved of different departments, different segments within the organization. They're going to be held accountable. And that's going to be one of the major goals, one of the major objectives that's going to allow us, hopefully, to increase performance by knowing who is responsible for specific goals and specific objectives. In order to do so, we need to outline exactly what those objectives are, what the goals are, what somebody or who has responsibility over what. And then we can use that to appraise the performance of those individuals that are in charge of those specific goals. We can allocate resources. We can look at which departments are doing well, which departments are underperforming and overperforming, and then decide how to allocate our resources based on that information. We can plan a strategy. Once we have this information, once we have the evaluation, we know clearly who's responsible for each goal. Note that as we go through the budgeting process, we're typically going to have a budget. We're going to compare to what actually happened. We're going to have differences. And we're going to say, okay, here's some weaknesses that we have. Now, the decentralization of the organization allows us then, if we have set really defined goals, to then go to the specific area that is responsible for the areas that we have problems in or need to improve with. And that's going to help us to plan our strategy as we go through and move forward through the process. So we have a similar kind of evaluation process for the performance evaluations as you would think for any type of evaluative process, including a budgeting process, in which case we're going to say, hey, here is our objective, here's the goals for the objective. But a key point to that, of course, is here's your specific objectives. Here's what you have control over as a department manager, and these are the things that we are going to evaluate you on. We are going to then have an evaluation and base that evaluation on these things. Then we'll run the actual process. Then we can actually have the numbers to make that evaluation, which we will then do. And then we'll go through the same kind of evaluation process again. Types of performance centers. Note that as we break up the company and have different people in charge of different areas, then some centers are going to differ from other centers. We can't measure, in other words, all segments of the company in the same way, because not all segments of the company are generating revenue. If obviously you are managing a segment of the company that doesn't have revenue generation, it would not be appropriate for us to measure the performance based on the amount of revenue generation. And this seems obvious, but it's kind of a common problem as companies grow, because you often focus all on revenue generation, which makes sense, but that's not going to be an appropriate measure to measure things like efficiency for types of centers and actions and activities that are not strictly revenue generation type of activities. So we're going to have things like a cost center. A cost center is not going to be revenue generation, right? It's just going to be in charge of costs. You need to have the cost center in order to run the company. And of course, the objective of the cost center is to manage the costs, to be able to deal with the costs in an efficient way. And we need to find and put together appropriate tools, appropriate benchmarks, appropriate measuring tools in order to measure the performance of the cost center. We've got the profit center, which will have a profit component to it, as well as costs. So the measurement tools that we'll use for a profit center will include the measurement for the revenue generation. And of course, we're considering the revenue generation over the costs. So they're going to have to control both the revenue generation and the relevant costs that they have control over in order to help to achieve the revenue generation. And then we have investment centers, which could be responsible for making appropriate investments and therefore going to have to manage the costs when we think about the types of performance goals and objectives to have and the return on investment for any types of investment decisions have been made. So our goal here in essence is that we have the company, we're going to break the company up into different types of centers. We're going to label those centers as cost centers, profit centers, investment centers, then put together appropriate goals to help the measurement of the performance of those centers. Of course, each of the centers will have somebody in charge, some people managing those individual centers, and they will be responsible for these areas and therefore will be able to assign the responsibility of certain outcomes to those centers and be able to measure performance in that way and hold people accountable in that way, and of course reward people for doing well and allocate our resources more appropriately. In this presentation, we will discuss controllable versus uncontrollable costs. When considering controllable and uncontrollable costs, we're imagining our responsibility accounting system. We have our organization, which we're breaking up. We're decentralizing. We're giving responsibility to different managers of different segments of that organization. As we do so, we can use the tool of controllable and uncontrollable costs. We can break the costs out into controllable or uncontrollable as we measure the performance for different segments, for different areas, for different units of our responsibility accounting organization for our company. With a controllable cost, a manager has the power to determine or at least significantly affect the amount incurred. In other words, they have some control over it, and therefore they're responsible for it. When we consider how we're going to evaluate someone's performance, just as we would on their personal performance, we say, hey, do you have control over what you are doing or not? What is happening here or not? If you do not, then we can't really hold you responsible for it. Well, of course, that's going to be the same idea or concept for responsibility accounting. We want to look at those costs that are going to be something that they have control over. And if they have control over it, then we hold them responsible for those kinds of costs. For example, a department manager will have control over the supplies used by the department. That's going to be something that they're going to be held accountable for because they have control over the supplies that are used. We can contrast that to uncontrollable costs. Costs are not within the manager's control or influence. If something is not in our control or influence, it's not reasonable for us to be held accountable for it. The same concept, of course, is true for responsibility accounting. If we're talking about management, we're trying to create different centers so that we can hold people responsible for, we can assign responsibility to different areas. It would not be fair for us to hold someone responsible for a management position over those type of costs that they do not have control over. So we want to identify those things. What type of things do they have control over? What types of things do they not have control over? And then measure performance on those things for which they have control. A common example of an uncontrollable cost is the department manager's salary. In other words, if we were running the department, then we have control over the costs of the department, such as the supplies and whatnot that are going to be used and consumed within that department. But our own salary is not something that we have control over. We can't change our own salary. That's going to be someone above us who has control over our own salary. Note that the department manager's salary is something that we would allocate to the department for other types of decisions. For example, if we were making a decision as to whether we want to keep the department going or not, and the department manager was a manager of that particular department, and if we no longer had the department, then we would no longer have the department manager's salary. Under those conditions, those types of decisions, we would say that the department manager's salary is included within the department when considering those types of decisions. However, when making the decisions on the performance of that department manager, we don't include things that that department manager does not have direct control over. Their own salary is something that they do not have the direct control over. Note that the difference between a controllable cost and an uncontrollable cost isn't always as cut and dry or as easy to determine as we would think. However, it's something that we want to break out in order to do the best we can with assigning responsibility and being fair with the evaluations that we make. The distinction between controllable costs and uncontrollable costs is not always as easy to determine as we would like, but of course we're going to do our best job that we can to distinguish between controllable and uncontrollable costs so that we do the best job that we can to assign those costs, to assign responsibilities, to make appropriate measurement tools for our management team so that we have the most efficient type of outcomes that we can have, the most fair type of outcomes that we can have. Whether something is controllable or uncontrollable typically depends on the level of management and the type of costs that we're talking about. If we're talking about the lower level management, we're usually talking about the people that are directing and managing the day-to-day type of operations. They're going to be in control over those types of costs that are more short-term costs over the day-to-day type of operations. If we're thinking about something like the rent, or if we're thinking about something like insurance, something that's going to be more of a long-term type of costs, people that are managing the day-to-day operations will not typically have control over those type of costs. However, the next level up will possibly have control because they're going to be the ones that decide things like the rental agreements, the leasing kind of terms and things within that nature, within that time spectrum, within that time horizon. In this presentation, we will discuss direct and indirect expenses. When considering our responsibility accounting, we have our decentralized system. We have our organization. We have decentralized it. We now have responsibility segments. We have managers that we're holding responsible for different areas, different segments, different units, different departments of the organization. As we consider the costs that will be assigned or applied to those different units of the organizations, it's important for us to distinguish between the direct expenses and the indirect expenses. So in other words, when we are assigning costs to a specific area or unit or department within an organization, we will often break them out for managerial accounting purposes by direct expenses and indirect expenses. And in some ways, we have to do it this way, and we'll see why as we define direct and indirect expenses. So direct expenses are incurred for the sole benefit of a specific department. So direct expenses then are easy for us to basically assign to a specific department because they are incurred directly by that specific department. So in other words, one common example for a direct expense is a worker or an employee that works exclusively within one department. It's not difficult for us then to say, well, the wages that that worker earned should be assigned directly to that particular department. There's no question about that. Easy to do. We say, here's the cost. We know where it goes. It goes to that department. Why? Because that worker works for that department. So direct expenses are nice in that way. However, we also have indirect expenses. Indirect expenses benefit more than one department and must be allocated between departments that benefit from them. Now, these, of course, are the ones that are going to be more complex for the accounting department. In other words, we've got multiple departments. They all have their own kind of costs that are specific to those departments, but there's also going to be those costs that are going to be needed by the department but are going to be used by multiple different departments. Those costs are going to be more difficult. They're often costs that possibly the departments themselves don't have as much control over. So when we consider controllable or uncontrollable type costs, the costs that aren't direct costs to the department might be costs that are going to be less controllable, and therefore when we consider responsibility accounting, whether they have responsibility over those costs, whether we hold them accountable for those costs, possibly not. But in terms of assigning the cost to the department to consider other types of questions, such as how is the department doing overall, or should we keep the department or not? Is the department providing profit to the organization in general or not? We would want to assign the indirect costs out oftentimes, and we need to find some method to do that. Now, if you're starting to consider how might you do that, it's a good thought process to consider, well, what if I was confronted with this problem and I have this cost that I need to allocate to these multiple departments, let's say 3 departments. Let's say it's a janitorial cost. Let's say they're all in the same building and we pay the janitorial costs for that building. We want to apply those costs to the 3 departments. Well, you might just say if there's 3 departments and it was, say, let's say 3,000, you could say, well, why don't we just divide it by 3 and apply 1,000 to each department? And that would be one method that you could do. You can apply out the indirect costs using that method. However, that method usually isn't used unless all the departments are even in size. And so oftentimes that's not going to be the case. One department might be a lot larger. It might take a lot more time for someone to clean one place than the other place. There might be some other way, some better way to measure. If they're different sizes, the question is, how can we allocate these costs in an appropriate way to the departments? And so we're going to have to figure out some kind of ratio analysis typically to do that. Let's first take a look at a forecasted department income statement so we can see the direct cost and indirect costs. And then we'll talk a little bit about the allocation of the indirect costs, and we'll spend more time on that allocation process in future presentation. So here's going to be an example of the forecast department income statement. We got the 3 departments, C, M, and P, and then the totals over here. Starts out as we would expect. We have the sales minus the cost of goods sold, giving the gross profit for C, M, and P, as well as the total. And then we have the direct expenses. Now, these are the expenses that we can apply directly to the departments of C, M, and P. So we have the salaries, the advertising, the store supplies used, the depreciation, and equipment. Again, these are going to be the straightforward costs, the ones that we say, hey, this is the amount that was incurred by that actual department. It's not difficult for us to apply them out. We'll see more examples of this as we go through future presentations and examples. Then we're going to have the indirect costs, and these are going to be the costs that aren't as easy to assign directly to a specific department because they're going to benefit multiple departments. And here, some common examples are rent and utilities. We'll take a look at more examples in the future, but the point is that if we think about something like the rent, and we have multiple departments in the one building that we are renting, then we have to in some way apply out the rent to the multiple departments. And so we're going to use some type of allocation method to do that. Then we're going to have our total expenses and our net income. Here's a quick example of a ratio analysis we may use to assign out the share of office department expenses. So if we consider the office department expenses, we may know the total, the 23,200, but we don't know how exactly to apply them out to the 3 departments. We could divide it by 3, but maybe the 3 departments aren't the same in size. We need to find some method that's going to be useful for us to apply them out. So in this example, we're going to use sales, and that means we're going to use sales and apply the ratio of sales by each department, use that ratio to then apply the 23,200 share of office department expenses. So we're going to take the percent of sales, and this will be a common calculation. We'll do a lot more examples of this as we go, but in essence, we're going to take C sales, 183,600, divided by the total, 360,800, and that gives us, if we move the decimal over, about 50.9%, about. And then if we take the 124,200 divided by the 360,800, we get about the 34.4. And then of course, if we take the 53,000 divided by the 360,800, we get about the 14.7. So use those percentages to apply out the 23,200. So in other words, we can take the 23,200 multiplied by the 50.9%, the 0.509, about, remember there's rounding, so it's about 11,806. Again, there's rounding involved. And if we took the 23,200 times the 0.344, we're going to get about the 7,986. And if we take the 23,200 times the 0.147, we get about the 3410, which will add up to the 23,200 that we applied out here. So that's one example. We'll take a look at some more example. Note that we used sales here, That's not always going to be the case. That's one thing that we could use. Choosing what the activity base should be in order to allocate out the indirect costs is going to be one of the challenges that we will need to do in order to assign out indirect costs. In this presentation, we will take a look at the process of the allocation of indirect expenses. You'll recall that we have a decentralized system. We're discussing a system where a company is breaking up into departments and providing responsibility for different departments. We then need to track the performance of each department, and we have two types of expenses that we're going to allocate to each department. The direct expenses, ones that we can track to that department directly, and the indirect expenses, those that we're going to have to allocate to those departments. And then, of course, the question is, well, how do we do that? How do we do this allocation process? In other words, we have an expense here that's going to be benefiting multiple segments, multiple divisions of the company. For example, if we had the maintenance service on the building, we would need to allocate that to the departments that the maintenance service is covering. And we might say, well, if there's 3 departments, we should just take the cost of maintenance divided by 3. That would be one allocation method. A very simplified allocation method may be applicable in some cases. However, it might be the case that these 3 departments are different in nature. In other words, one might be larger than another, and therefore it would be more appropriate for us to allocate on some other basis. We should allocate more to the larger department than the smaller department. Once we do that, we then need to decide, well, how are we going to do that? What's going to be a fair way for us to break out this cost of the maintenance, for example, to the 3 departments that are being covered by it? We're going to have to use some type of percentage method. And to do that, we'll typically use some type of activity base in order to allocate that. For example, if we're talking about maintenance, usually the square footage that is being covered is going to be a relevant activity base, because it would seem reasonable that the maintenance would spend more time on the larger areas than the smaller areas. And if we use a proportion of square footage as a percentage to then allocate the cost between the departments, that seems like a fair way to go. However, the square footage might not be the case, might not be the best activity base to use for other types of activities, for other things. And therefore, our goal then, when we have allocations such as this, is to determine what it is we're trying to allocate, figure out what an appropriate activity base would be, something that we can then use on a percentage basis to then use those related percentages to allocate out the cost. So here's some common types of allocation bases, activity bases, common things that we would need to allocate out. If we're allocating, for example, something like wages, let's say we have someone that we are paying that is going to be in charge of multiple different departments. Well, then we might look at the hours worked per department to allocate out those wages. In other words, if we're talking about wages of individuals that are working in multiple different departments, then we can think and say, well, what would be a good activity base for us to use to apply out wages to multiple different departments? Well, if we know the hours that people have worked within different departments, we can use that on a ratio analysis. We can look at the hours, we can figure out the relative hours per department on a percentage basis in relation to the total, adding up to 100, of course. Use that as our method of allocating out the wages to the departments in accordance with that ratio. If we're talking about something like rent, let's say we have these 3 departments that are all in the same building, and we have to apply the rent. They all, of course, are using the rent in some way that we have to pay for the building. We want to apply that out to the departments in some way. Well, that would commonly be used. The floor space seems like a reasonable activity base there, because clearly if you're talking about the rent, you would think that the square footage of the floor space would be something that would be reasonable for us to use as an activity base to then allocate out the cost of the rent to the departments, because larger departments then would have more of the rent. Now, again, you could have differences here, because you could say, and we'll look at some problems where we say, no, that's too simplified. What if the first floor is more highly valued than the second floor, and the rent on the first floor would be more highly valued than the rent on the second floor? It could be that it would be more appropriate to have some bit more complex type of activity-based allocation in something like that. But you could see our goal here is to pick an appropriate activity base, the floor space, using the relative floor space between departments to get ratios, percentages we can then use to allocate out the cost. Advertising. So the advertising, we might have advertising for multiple different departments, and we have to apply out the advertising budget to the costs to the multiple departments. Now, a common activity base there is sales revenue, because there could be a correlation, of course, we hope, that the advertising is correlated in some way to the sales revenue. So we might look at the relative revenue generation, draw a percentages of the departments in revenue, use those percentages to then apply out to advertising. Now, once we get this concept down, we'll talk about this concept of how we do these percentages, then that becomes pretty systematic. Once we know how to do that, we'll come up with these ratios. That'll be fairly easy. We just need to realize that we can use different type of activity bases to run these ratios, and we want to use the best activity base that's going to be driving what the relative size, what the relative cost will be appropriately to the departments. So then we might have depreciation. We might have the building. What if we don't rent the building? We have depreciation on the building, or let's say depreciation on equipment. So if we're talking about depreciation on equipment that's going to be used by multiple departments, then we might have the hours used per department. To do that, of course, we would have to track the hours that are being used for the piece of equipment. And then once we do that, we can add up the hours, and we can use a ratio analysis comparing the hours used in one department versus the hours used in another department. And we can then apply that out and apply out the depreciation to the appropriate department based on that ratio analysis. Utilities. Again, we might have the whole building. We might pay one utility bill. We don't pay utilities per floor, possibly. If we did, then that would be one way to go. If we don't, then if we don't pay utilities per department and we pay one utility bill and we have 3 departments in it, how do we allocate the utilities? Again, another common way we might do that is an easiest way would say the floor space occupied, because you would think that larger floor space being occupied would then have more utility. Now, again, you might argue that that's not the case, because you could have one department that uses a lot more utility than others for some reason or another in some circumstance. And if that's the case, then you'd have to make some adjustment for that possibly in order to appropriately allocate the utilities. If all the departments you would think are just doing this normal stuff, the lights and whatnot in the offices, then you would think the floor space would be a relevant activity base to use. So just note, these are going to be some common kind of ways that we can apply out. What we're looking for, of course, here is some type of activity base that's going to be related, a cost driver driving the cost that we have, some type of activity base that we can quantify in some way, and then compare departments so that we can have a ratio analysis comparing the relative use of the activity base from department to department compared to the total, resulting in ratios or percentages that add up to 100, which we can then apply out the costs based on. So again, once you know this concept, then you can apply it, and you know the activity base, then you can apply it to whatever activity base is being used. As we allocate the indirect expenses out, recall that the service departments are going to be something that we allocate indirect expenses to as well. And then we're going to take the total of those service departments and we're going to use them to allocate to the revenue generating departments as well. So something like the maintenance, we're going to say, okay, anything that needs to be applied to the maintenance that's indirect, that should be applied to the maintenance department, we will apply to the maintenance department. Once the maintenance department has been completed, we know the cost of it. We're going to take that total cost for the maintenance department and apply it to the rest of the department's revenue generation departments to complete the process. We'll use a similar basis in order to do that, or a similar process to do that. We'll determine an activity base. We'll use that ratio process to apply out the entire service department to the relevant departments to apply them out to, with the similar or same ratio analysis, choosing an activity base that would be appropriate for that allocation. In this presentation, we will take a look at an example of the allocation of occupancy costs. In this example, we're going to have a little bit more of a complex example, a little bit more of a back and forth kind of process. Our goal here, of course, is to allocate the occupancy costs of a building to the departments within it. We're going to use an activity base in order to do so. But we want to show that this is not, of course, an exact science. There's not a right and wrong answer to do this. This is going to be a managerial accounting decision-making process. Often there's going to be some back and forth in terms of making this type of decision. We want to show one example of how some kind of back and forth could work, some changes that could be made. Again, it's up to management as to whether or not They want to get more detailed into the allocation and how to use different activity bases and how complex of an allocation base they want to use. There's going to be a trade-off, in other words, between the amount of time it takes for us to allocate based on more complex methods, and time, of course, is going to be reflected with money, and the added benefit that's going to be incurred, the added benefit being hopefully a more detailed method showing a better, more accurate allocation that people feel is more fair. Note, however, that if it's going to be feeling more fair, it has to be communicated very well. So we could have the most accurate type of allocation methods, but if they're too complex in that we can't communicate those methods to people, then we're kind of losing some of the benefit because, of course, the people involved, the goal of us having more complex methods is to make it fair so that we can explain the process so people understand the way things work and can work within the system. If it's too complex to do that, then it's going to take away from that goal, that objective. So let's go through this problem. Here is our data up top. We're going to have the occupancy costs. We're going to call it total occupancy costs. Those will include depreciation on the building, interest on the building, land taxes, gas, lighting, maintenance. We're going to say that those all add up to $80,000. We're going to call those occupancy costs, and we're going to say that those are going to be affecting multiple different departments that are in the same building, and therefore we want to apply that $80,000 out in some way. Now just recall and remember that we could do this multiple different ways. We could have gone back into each one of these line items and said, here's depreciation, how should we apply that out? What activity base should we use? Here's the interest, what activity base should we use? Here's taxes, what activity base should we use? And apply them out using different types of activity bases, the ones that we think are most applicable to those particular costs. But given the fact that these are all related to the building, we can also add them all up and say, hey, we want to use the same type of activity base, the same method for the allocation of all these costs that we're going to call total occupancy costs between the departments. That's what we'll do here. We're going to then take this 80,000. Once we make that determination, we have to say, well, how are we going to allocate that out? We could just divide it out by the number of departments that are there, but that's not very fair given the fact that some departments are going to be larger than other departments. And notice our goal here is always to try to say we want something simple, but we want it to be fair. And those things don't always line up, but we want it to be as simple and fair as possible. So those are kind of our goals. And so given that, how can we break out this 80,000? Well, we can say the square footage per floor is 5,000, let's say, and the occupancy cost we just said is 80,000. Total square feet are 10,000. So if total square feet are 10,000 and there's 5,000 square feet per floor and the occupancy costs are 80,000, one thing we can do is say, hey, let's use the square footage as basically an allocation base. And one way to think about that is we can say, well, if the total costs are 80,000 divided by 10,000 total square feet, then we can say if we divide that out, we can apply out $8 average cost per square foot for occupancy. So then we could take this $8 per square foot and apply it out to all the departments because we're going to basically apply out the full 80,000 based on the square footage. Now we're going to be concentrating on department L and C. These aren't the only departments. We're just concentrating on L and C, and we're saying L is a first floor department, square feet, 900 square feet. C is on the second floor and has 1,900 square feet. So if we apply out this method for these two departments, then we're going to say, well, it's $8 per square feet that we're going to apply to your department based on this 80,000. We're just going to say here's L and C. Here's their square footage, 9 and 1,900. Here's the rate, $8. We apply out 900 times 8, 7,200. 1,900 times 8, 15,200. So this is a nice, easy method. Again, this doesn't add up to the 80,000 because we're just focusing in on department L and C at this time. So these are two departments that are involved in this scenario. This is how we would apply them out. We would then apply out this 7,200 to L, and C would get the 15,200. Now you can think about this scenario and you can imagine kind of the competition or the allocation between the departments because of course they're going to be measured based on their performance and in some degree or to some extent the amount of allocation of these items. And now again, these might be controllable costs or non-controllable costs, but in any case, they would rather have less costs allocated to their departments, right? So the managers of L and C are always going to try to be reducing their costs. And C got allocated 15,200 costs versus 7,200. Would make sense, you would think, because of course they have more square footage than L has. But you can imagine them making an argument and saying, well, that's not really fair based on this information. And say the next meeting, they come up, C would basically say, hey, we're on the second floor, and based on the average value of the floors, the second floor is worth a lot less than the first floor. So depending on what the company is doing, this may be relevant or not. So it might be the case that C is saying this isn't a fair allocation because L's on the first floor, and that's much more valuable square footage space, and you're allocating as if the two floors are completely equal, and that's not fair. If you look at the value of the floors, you can see that the second floor cost per square foot is $10, and the first floor cost per square foot is $40. So this doesn't make sense for you to be allocating evenly as if it's an even allocation, when clearly it should be weighted more. You should be allocating more to L than to the C department. So C department, of course, is arguing for less cost to be allocated to their department based on the market value. So then if they ask the managerial accountant, we're going to say, well, that could be true, but that's going to add a whole lot of complication to, this is a pretty simple calculation. If we take that into consideration, it's going to complicate things. Do we really want to do that? And if the top management says, yes, we really want to do that, we think the added complication is worth the time, then we're going to say, oh, okay, we'll figure something out. So now we got to figure out how to take into consideration the fact that the cost is going to weigh in on the amount of allocation in some way. So that's going to complicate things a pretty good deal. So now we're going to say, all right, well, let's break out our costs first between the value-based costs and the usage-based costs. So value-based costs, we're going to say, is the depreciation, the interest, the taxes. Those are going to be things that are going to be more heavily weighted by the value of the property, because if you're talking about more valuable property, you would think the depreciation, the interest, and the taxes should be allocated more to those items because of the value of the property. Whereas the usage-based items, gas, lighting, and maintenance, those things shouldn't change based on the value of the property. So the first thing we're going to do, and note as a managerial accountant, when we're figuring this out, and we're trying to make the two departments happy because we want them to compete to some degree, and we want to keep them happy and make things fair. If this is a relevant issue, we want to make this as fair as possible. So we want to break this out and say, hey, this is as fair as we can make it. These are value added costs, and they could very well be influenced by the value of the square footage. These are non-value added costs. They're based on usage, and therefore the value should not be there. So that should hopefully make both sides of this happy, both department managers happy that we're taking into account consideration the value for these costs, but not for these costs. That's our goal, at least. So then we're going to take that and we're going to take, okay, here's the square footage for the first floor and the second floor for our departments, 5,000 and 5,000 for the total of 10,000 square feet. And we're going to take our $40 and $10, the cost per square foot. So we're taking the market cost times the square footage for the first and second floor. First floor, we had 5,000 square feet. The market cost is $40. Second floor, 5,000. Market cost is only $10. That would give us $200,000 and $50,000 or $250,000 total for the total market value. Again, that's not our cost. That's like if we sold it today, according to the market value that we got these numbers from, then we would have a total value of $250,000 for the two floors, $200,000 for the first, $50,000 for the second. We're only going to be using that to help us with our allocation method. So now we're going to take that and we're going to say, all right, let's take that 200 and that 50 adds up to the 250 and have a percentage that we're going to take of that. So the 200,000 divided by the 250, that gives us 80%. And then 50 divided by 250 is 20%. That, of course, adds up to 100%. And then we can take our allocated costs. So we're going to say the allocated costs, and we're picking up our value-based costs now. So the depreciation, the interest, and the taxes, we're picking up this 66,250 and applying that out based on an 80-20 basis. So we've got our 66,250 times 0.8, 80%, 53,000, 66,250 times 20%, 13,250. That adds up to the total 66,250. And we need to break that out. Now, that would be for the entire floor. If we had one department per floor, then we could use those numbers. But we have multiple departments on multiple floors. So now we need to take that and get the cost per square foot. So this would be the cost per floor. Now we need the cost per square foot. So there's 5,000 square feet on each floor. So we're just going to take the 53,000 divided by 5,000. And that's going to give us 1060. And then we have the 13,250 divided by 5,000. So that's the 265. So that's going to be the cost per square foot of this 66,250. And then we're gonna say, okay, that's the cost per square foot for the 66,250, which is the value-based allocation rate. Now we need the usage-based allocation rate, which is going to be 138. That'll be more of a straightforward type calculation where we have the usage-based costs. We said that was the 13,750. And that's with the usage-based, the gas, the lighting, and the maintenance. And we applied those out straight out. We didn't have to value it differently based on the value of each floor. So we're just going to take then the 13750 and divide it by the total square footage, 10,000 for the two floors, divided by 10,000 for the two floors. Means that we get 1.37, about 1.38. That's what we'll use for the usage-based allocation rate. And of course, it's the same for both the first floor and the second floor because it's based on usage, not on the value. And if we add those two up, we've got the 1060, which we broke out, and the value-based rate, and then the usage-based rate. And that comes up with a total for the first floor is going to be $11.98 per square foot. And on the second floor, it's only $4.03, the 265 and the 138. So now we can then use these rates depending on the floor that we have in order to allocate out the 80,000 costs and take into account the weighting of the different values of the floors. So if we just take a look at these two departments then, L and C, their square footage was 1,900. Again, these aren't the only departments on each floor, but they happen to be on two different floors. And these are the two people that were involved in our discussion about the values of the two floors. So we're going to say, okay, the 900 times the 1198 versus the 1,900 times the 4.03 comes out with these totals. So these would then be the allocation of the costs to these particular departments, one being on the first floor, one on the second floor. Now you can see the comparison. This is what we did last time with a really easy type of calculation, straight $8 per square foot, very easy to calculate. We just used one activity base, we calculated it out, and we come up with very different numbers the way we basically tried to weight it out. There's no correct method to do this. This is what we decided on doing. We decided to say, management basically decided that this is a more fair method. It's going to be more difficult to explain to people, however. Note that if you're in a meeting and you're trying to explain this calculation and how it's fair, and that's what we're going to have to do. Note the next meeting that comes up, we'll probably see that L is going to look for some type of thing that's going to be a problem with this type of calculation, because now they got more allocated to their department, way more than the prior time period. And so if they can see any problem with this calculation, they're going to say, hey, I don't agree with this calculation, and we could go from there. And so notice this negotiation can keep going from that standpoint. So the next time, and we on the managerial accounting side are going to have to say, hey, this is why it's fair, this is how fair it is, and whatnot. And then one of the arguments, of course, could be, well, this may be fair, but it's so complex that nobody understands it, and which could be a valid argument, right? As we get more complex, and or it's too costly to go through all these. We're getting too extreme on these type of calculations. The cost is worth more than the added value we're getting from it. So those are two types of arguments that could come up as well. So we can expect at the next meeting then L and everybody else that's on the first floor to look for some problem with this type of allocation method, number one. And then number two, possibly upper management, as these kind of games get a little bit out of control, at some point might make the argument that says, hey, these things might be the most appropriate thing to do, but they've gotten to the point where we don't really understand what's happening anymore. So if we can't explain these things, then even if they're more appropriate, they're costing too much, and they're not adding the value that they should. So those are types of things, types of back and forth with these types of concepts that will typically occur. In this presentation, we will go through the process or the steps for the creation of a departmental income statement. First, we'll list the steps and then we'll go into some more detail about them. So this is going to be the departmental income statement steps. Number 1, accumulate revenue and direct expenses by department. This should be a fairly straightforward process. If we're talking about a department that generates revenue, we should be able to apply that revenue directly to the departments. That's how we track the revenue. Should not be a problem there. The direct expenses, similarly, are items that we can apply directly to the department as well. So this should be a fairly straightforward process. Then we're going to allocate indirect expenses to departments. This is going to be the more complex process. We're going to have to find those expenses that are going to be allocated or that are benefiting multiple departments. We're going to use some type of allocation method to allocate them between those multiple departments. And then we're going to take and allocate the service department expenses to operating departments. Remember that these service departments are not generating revenue, so ultimately we want to take the total costs of the service departments and apply them out to the operating departments, those that are generating revenue. So to do that, we're going to allocate the indirect costs that are applicable to those service departments, those required departments that are required but aren't generating revenue. Once we have done that, once we've applied all costs to the service departments, we know what their total cost should be. We're going to take those total costs and we are then going to apply them out to the operating departments, the departments that are generating revenue. Then we'll prepare the departmental income statement. Let's look at this in a bit more detail. So we have step 1, accumulate revenue and direct expenses by department. So we're going to have the revenue and direct expenses. We're going to apply them out directly to the department. So in our example, we're going to say that we have 2 operating departments, departments that generate revenue and have costs. So department 1, department 2. Again, it should be easy for us to allocate the revenue and expenses because we're tracking revenue by department and the expenses can be applied directly to each of the departments. There will be some departments that do not have revenue, but only expenses. So if we're talking about service departments, then they don't have any revenue. They're going to be a necessary process. Their job is to manage the expenses in order to achieve their job. So we've got the direct expenses. Again, it should be easy for us to allocate the direct expenses directly to each of these departments. They're not something that are benefiting multiple departments. They are something that are going to be applied directly to these departments. Now, once we have finished these service departments and allocated all costs to them, we will take those total costs and then allocate them to the operating departments. But at this stage, at the allocation of the direct expense stage, we are allocating those direct expenses that are applicable, whether we're talking about the operating department or service departments here. Service departments, of course, only having expenses, not having revenue. Then we're going to allocate the indirect expenses to the departments. This is the bit more complex step, of course, where we're going to take the indirect expenses and allocate them. This is where we use our allocation methods, where we have to think about an activity base. We have to find some way to allocate the indirect expenses between the operating departments 1 and 2, and the allocation between the service departments. So we're going to take those indirect expenses, we're going to allocate them. We might use different activity bases. We could have a very complex system to use many different activity bases and different systems to put this allocation together. Or we might have a very simplified system where we use basically one activity base to allocate everything out. It depends on the system that we are using, but these are going to be costs that are benefiting multiple different departments. We'll need some type of process to allocate them out to determine how much of them to apply to each department. We'll apply those costs out to both the operating departments and the service departments. The next step is to allocate the service department expenses to the operating departments. So remember, these service departments don't generate revenue, and of course the goal of the company is revenue generation. That means that these are necessary departments, but they're just managing the costs. And ultimately we want to take the costs of those service departments and allocate them to the operating departments, the revenue generation departments. So once we've allocated all the proper costs to the service departments that are necessary, we're going to take that total service department costs and we're going to allocate them to the operating department. So service department 1, we're going to use some type of allocation method because they're benefiting, most likely the service department is benefiting the 2 operating departments. So we'll have to use some type of activity base, some type of method to take the total cost of the service department, allocate it between the operating departments. And we'll do the same for the service department too. We'll say, okay, these are benefiting both departments. How can we take some type of activity base, allocate this costs between the operating departments? Once we've completed those steps, then we'll take this information and prepare the departmental income statement. In this presentation, we will work an example problem related to steps to take to create the departmental income statement. Here's a review of the 4 steps that we will take to create the departmental income statement. We will accumulate revenue and direct expenses by department, allocate indirect expenses to departments, then allocate service department expenses to operating departments, and finally we will create or prepare the departmental income statement. So our first step is to accumulate revenues and direct expenses by department. This should be a fairly straightforward process. This is going to be the worksheet that we will be using. We've got up top the allocation base. This is what we're going to be using to allocate certain items, typically being the indirect items. We've got the total expenses. This is an item that we're going to assume we know. In other words, we know what the total expenses are. What we need to do is break those total expenses out into the departments. Sometimes this will be easy with the direct expenses, sometimes more difficult, such as with the indirect expenses and ultimately the service department. We then have our departments. We've got the Service Department 1, Service Department 2. These are non-revenue generating departments. So they are there to support, of course, the revenue generation departments because the revenue is the goal of the company. So we are going to apply indirect costs as well as direct costs to these service departments, and then we'll take those and we will then allocate them to the operating department or sales departments, departments that have revenue related to it. We're going to say there's 2 of those, sales department 1 and 2. Again, these are operating departments, departments that have both revenue and expenses, departments for which we will finally apply after we've found out what the service department expenses will be or costs will be. We will ultimately apply them out to sales department 1 and 2. First thing we will have are the direct expenses. Now the revenue, of course, should be fairly straightforward. We will be able to, on our income statement, allocate out the revenue by the departments, the sales departments or operating departments, because of course we know which departments made those sales. And then we have the expenses, which we have the 2 components, the direct expenses. These are going to be the ones that are going to be easily allocated. So we're going to say, here's the total direct expenses. We're going to allocate those out by department. The Service Department 1, Service Department 2, Sales Department or Operating Department 1 and 2. We know where those go in this case because they're direct expenses. In other words, these people that earn these salaries work for exclusively these departments, and therefore it is easy for us to apply out the salaries to them. Supplies, we're going to say, is the same way in this example. We've got the 1,500. We have the supplies broken out. They're already broken out by department within our accounting system, and therefore it's easy for us to break them out as direct expenses to the departments that were consuming them. Then we have the indirect expenses, examples of indirect expenses. Remember that the indirect expenses are those that we don't know how to allocate them. In other words, we know what the total is, but not what to allocate them or where to allocate them. We're going to be using rent and utilities. So we're going to assume that these 4 departments are in the same building. We pay rent, we pay utilities on that building. We're not able to break them out between the departments easily. We're not basically getting billed based on the department that are consuming the building, and therefore we have the totals that we need to allocate out. We can use an activity base to do so. Common example in this case of rent and utilities would be the floor space. We can look at the square footage of each department in comparison to the total to get that kind of comparison to allocate out. We're going to say we know what the totals are. So they're 11,000 and 1,200. That's what we know. What we don't know is how to break them out into these 4 departments. You could say, well, why don't we just take that number, the total that we know, divide it by 4, allocate it out? Well, 1, because these departments aren't the same size, most likely. That's going to be the most common difference. If we say that's the case, then we have to allocate based on size or based on some relevant activity. To do that, we use an activity base. That base we're going to use is floor space. We would think that would be a reasonable ratio to use to help us to allocate these expenses related to rent and utilities. To do that, we would need the floor space for each of our departments. We're going to say that Department 1 is 240, 2, 240, Department 3, 720, Sales Department 1, Sales Department 2, 720, and 1,200. We then look at the percentages. So we're going to say, all right, here's 240 divided by the total. And that's going to give us 10%. If we move the decimal over 2 places, and then 240 of obviously again, and then the 720 divided by the total, and so on and so forth, there's the 30%. Now, of course, it all has to add up to 100% when we do this, because this is the point. All we're doing is saying, well, this is the square foot per each department. That means we own a total of all the departments, or 2,400 square feet, and then we just take the square footage of one department in relation to the total. If we do that for all departments, then we get percentages which must add up to 100%, percentages that we can use then to allocate out whatever we decide to allocate out with it, in our case, utilities and the rent. So if we go back up to our worksheet, then we can take this 11,000, and of course we're just applying it out in accordance with our percentages over here. We're going to say, all right, 11,000 times 10% is going to give us 1,100, 1,100, and then 3,300, which is of course 11,000 times 0.3, and then of course 5,500. We're going to do the same for the utilities. So we've got 1,200 times 0.1 is 120, and so on and so forth. If we take the 1,200 times 0.3, that's giving us the 360. And then of course, if we add these up, so if we add up the first row, 1,100 plus 1,100 plus 3,300 plus 5,500, that's going to add up to the 11,000. So all we did was allocate these two items out in accordance with these percentages, not because the floor space has anything to do with the rent or the utilities per se, but because we think it's a relative good activity base to use to allocate out the expenses of rent and utilities expense. Then we have the total department expenses. So we're adding these up, both the direct and the indirect. So 20,000 plus 1,500 plus 11,000 plus 1,200 for the total expenses. Service Department 1, 1,100, 1,100, and 1,020 for a total of 2,320. Now we have this situation where we've basically completed these two service departments. We have allocated the expenses to them that we need to, including the direct and indirect expenses. There are no revenue related to them because they're a service department. So our ultimate goal is the sales department, our operating department, the departments that do generate the revenue. Therefore, we need to allocate out the service departments to the sales department. So once these have been completed, we're now going to take our next step to allocate them out to the sales or operating departments. Now, we're going to use a different activity base to do this. For our first item, Service Department 1, we're going to use sales. Again, why would we use sales? Note that we just picked sales as a good activity base to use. Sales has nothing to do necessarily with Service Department 1, but it's something that we can use to then apply out Service Department 1. And maybe sales is going to be a good way for us to look at the relative size of Department 1 and Department 2 with relation to Service Department 1. So what we're going to do is say, okay, here's the sales for Department 1 and Department 2, 40,000, 48,000 for a total of 88,000. Same kind of ratio analysis. We're going to say, all right, we've got the 40,000 divided by 88,000 is about 45%. 48,000 over 88, about 55. That adds up to 100%. Again, we just chose the activity base of sales because that was our managerial decision to do so. We think it's a relative activity base. Then we're going to say we're going to use this to break out the service department. How? Based on a 45-55 percentage breakout. So then if we do that, we're just going to say, all right, here's the service department. It was at 2,320. We're going to remove the entire 2,320 at this point and apply it out to the sales department or operating department 1 and 2. How will we do that? We're going to break it out 45-55, right? 45-55%. So we got the 2,320 times 0.45, 1,044. Now note there's rounding, of course. So it was really, if we took the the actual percentage, it was 40,000 divided by 88,000, which is really 0.454545 times the 2,320, and that's going to give us closer rounding to 1,055. Note there's always going to be rounding issues. These are estimates, of course, and so even, if we round it to the penny, we're still going to have rounding issues. So we've applied this out. We take this, we're going to apply it out, and then we're going to do the same thing for service department 2, the second service department. This is still here, 3,520. We need to apply it out to the operating departments. We're going to do that with a different activity base. Why? Because we as the management think that employees is a better activity base to apply out this service department. So that's going to be a managerial decision to make. We decide that the number of employees, we count them. There's 36 in Department 1, the sales department or operating department, and 52 in Department 2, same ratio analysis. 36 over the total of 88, because 36 plus 52 is 88, is about 41%. And then about 59% is 52 over 88. So if we take those numbers then down here, we can use them to allocate out service department 2. And again, you might be saying, well, why did I use a different activity? Why did I use sales here and service department here? It's our managerial decision to do that. We picked the activity base that we think was most relevant. And then we applied, in essence, the same process, a ratio analysis, to use the relative ratios to apply out the costs. So once again, we'll remove the 3,520 from the service department, making it go down to 0, apply it out in accordance with our ratios. Remember that the ratio is rounded, so it's really going to be 36 over 88, or this is the real percentage we're using, times the 3,520. That's where we get our 1,449. So again, the rounding's not perfect, but remember, you got to deal with the rounding all the time. And then and then we have the 3,520 times the 0.59, and that gives us about the 7,076. If we add those two up, 1,449 plus the 2,071, that adds up to the 3,520. So we've applied out the 3,520 based on these percentages, based on the number of employees. So then if we take our totals in our worksheet, the total expenses, here's the total in the total column. We have now cleaned out the service departments, now at 0 for the 2 service departments. We allocated those expenses over here to the sales department or operating department. So now we're at 12,564 and 21,136, and now we can construct, in essence, our income statement with that. First, we'll take a look at a standard type of income statement type format where we have the total, we have the sales department 1, sales department 2, operating department 1, operating department 2. We've got the sales up top, which is going to be, of course, the revenue, the cost of goods sold. So we're going to subtract this out, sales minus cost of goods sold. That gives us the gross profit on sales. And then typically in a normal type of income statement, we would have the operating expenses. We have the operating expenses, which we're going to be pulling from the worksheet, the salaries, the supplies, the rent, the utilities, and then we have the service department 1 and 2, which we allocated out to the sales department, the 2 sales or operating departments. Now, we can see the items in green are going to be those direct expenses. The items in red are the indirect or allocated indirect expenses, and then we have the allocated service department in yellow. So if we add those up, we get our total expenses. If we add up all these items, all these expenses, and then the gross profit minus the operating expenses is, of course, the net income. Now we can change this format a little bit, and we see the departmental contribution to overhead type statement. Again, it's an income statement type of statement because this is a performance type of statement, but it's going to be broken out a little bit differently. We're going to be starting off the same. We have sales, cost of goods sold, gross profit on sales. We subtract sales minus cost of goods sold. Then we're going to take a look at those direct expenses, the ones that are applied directly to the department. So those in our case include the salaries and supplies. That gives us the total direct expenses. We're going to give a subtotal here of the total direct expenses, this being a bit different than we would see on a normal type of income statement because we're trying to get more information by department. So notice a normal type of income statement is really geared, for the most part, for the entire company as a whole. We're here looking at department. We want to measure same performance type numbers, but we want to break them out a little bit differently so we can apply them to departments a little bit differently and therefore hopefully make better decisions with it. So that's going to give us the department contribution margin, or the department contribution. And this can be an important number because note that we're talking about those expenses which, if we were to eliminate a department, would probably go away because these are going to be expenses applied directly to the department. In other words, if these people that earn these salaries work only for that department and these supplies were used only for that department, if we were to eliminate the department, then of course those amounts would go away, as well, of course, with the revenue and the cost of goods sold. The amounts that we apply usually are going to be more type of overhead type of amounts. So when we break out the amount we apply, indirect expenses and direct expenses, the direct expenses, if we get to the department contribution, this is going to be the amount that is going to be contributed basically to what might be thought of as overhead type of amounts. And then we apply out the overhead for certain types of decisions, but other types of decisions we need to understand that the overhead is an applied number, whereas the direct expenses are direct to the departments. For example, if we were making a decision on whether or not we should terminate a department, whether or not it's a profitable department or not, then we might use this department contribution number a lot because we know that this would be the number that would be eliminated. If this was a loss, then it could be the case that if we eliminate the department, then we might be better off as a whole. However, if the total net income for the department is a loss and this is a positive number, then we have to see if some of these allocated items that we're allocating to that department would be items that we can eliminate or not. So this is one reason we break this out in this format. Then we have the indirect expenses. These are the amounts that we're going to allocate. So that's going to be the rent, the utilities, service department, total service department 2, the total indirect expenses. Again, these are expenses that if we were to eliminate one of the departments, we possibly would not be eliminating these expenses, or at least not all of them. Because when we allocate them out, it's just an allocation that we're using. We're just using an allocation to allocate these costs that may be there even if the department was not there. It helps with some decisions, but we need to keep in mind that it is simply an allocation. And then we're going to have the net income. We calculated the net income just on the totals here and not on the allocated amounts. So we're just showing the net income on the totals. We're emphasizing here the department contribution in this case, in this format. In this presentation, we will take a look at an example of a forecasted departmental income statement. This is going to be our data. We have the income statement for the prior period, C and M being our two departments, and of course the total between them. We're going to be projecting or adding or thinking about adding a new department, Department P, and therefore going to have to add that to our forecast. The information for P that we have projected to be will be sales 53,000, gross profit margin 65%, salaries 8,500, advertising 1,000, store supplies 400, and equipment depreciation of 700. Added information: P will replace space currently used by the other departments. So in other words, we're not going to be building a new office or renting new space for P. P is going to be taking over some of the space that we currently have that is in use by C and M. So C and M departments are going to be replaced 20% and 25%, which will then be going to P in terms of office space. Office department expenses allocated in proportion to sales. Office department expenses expected increase 7,200 to the office department expenses. That's going to be these items here. And then there's going to be an increase in sales for C and M. We're going to say 8%. So we think these items are going to go up. The sales lines are going to go up, projected next time period, by the 8%. And then of course we're going to add P, which has got the sales number of 53,000. Store supplies increase in proportion to sales. So when we're considering the store supplies, it's going to go up with relation to the increase in sales, in essence, an 8% increase. So let's start to construct our projection. We're going to have C, M, and now P, our three departments that we will be constructing for. We're going to say that the sales is going to be our top line number. How are we going to get that? Well, we're going to start with prior year sales. So we had sales last time, 170,000, and we're projecting it to increase by 8%. We saw on the data on the prior slide. So it's going to increase 8%. So times 0.08, and that's going to be 13.6 plus the 170,000 or the 183.6. We could do that a bit faster by saying it's 170,000 times 108% or 1.08. If we move the decimal over 108%, that's going to be the 183.6. Then of course we do the same thing with M, so 115 times 1.08, that's going to be the 124.2, and then P is being drawn from this number. Then we're going to get the cost of goods sold, and we're going to assume here that the cost of goods sold is in relation to sales, because it typically is going to be, the cost of goods sold is going to be in relation to sales, and therefore we'll still have an 8% basic increase in the cost of goods sold. So with the cost of goods sold, we've got 83300 times 1.08, same process, 89,964. We've got the 71300 times the 1.08. That gives us the 77. And then there's a couple different ways we can work this out with P. We know that the gross profit margin is 65%. Now remember, the gross profit is going to be the gross profit divided by sales. And we're looking for cost of goods sold. And we know that the gross profit is sales minus cost of goods sold. So in other words, we know that if the gross profit is 65%, then 1 or 100 minus 65%, 1 minus 0.65, 0.35 or 35% must be the cost of goods sold. That's one way you can calculate it. You can think of different ways to calculate it, but we're going to say 35% times, and then we're going to say the sales item 53,000. So that's here. And that gives us our 18,550. Then we've got the gross profit, subtracting those two out for the gross profit. Then we're looking at our direct expenses. So the direct expenses, those that we can apply directly to our items, and we don't have to use the allocation for them. We include the salaries. So we're picking up the salaries from last time where we had the 20, we had the 8,7, and that's going to give us our totals. And then we've got another 8,500. We're thinking the salaries aren't going to change because they're salaried. So that's going to be straightforward. We just add the new item for P in our projection. And then we have the advertising. We were at 1,400, the 200, and then we're adding another 1,000 for P. So we're taking those directly from our prior numbers. And then we've got the store supplies used. For that, we're going to be taking the 950, and we say that it increased in the same proportion as sales. So we think it's going to increase in the same proportion store supplies. That would be a reasonable estimate. So we're going to take the same thing that we did the sales. There's the 950 times 1.08. So that's going to be the 1,026. We're going to take the 400 times 1.08. That gives us the 432. And then if we add those up, we get our totals. We got the 400 for our new department P. And then we have the depreciation on the equipment. We're going to say that's the same. We're going to keep it at basically a straight line method. It is what it is. So 1,700, 500. We think that for P, we're going to have new equipment that we're going to depreciate at 700 in our projection. So that's going to be our direct expenses. If we add those up, the 20 plus the 1,4 plus the 1,026 plus the 1,007 is the 24,126, and so on. Then we have the allocated expenses or the indirect expenses. We're going to be looking at the rent and the utilities. That's going to be the first calculation we need to take a look at. So to do that, we can look at what we had last time. We had the rent expense and the utilities expense. So we're going to start with the rent here. We're going to say, here's the prior year rent. It was the 7,120 C and 4,080 for M. So that's going to be these two items. Obviously, nothing was there for P. P wasn't around. And then we're going to be allocating 1/5 from C to P. Why? Because we said it was a 20% allocation. If we think about that in terms of a ratio, it's 1/5, 1/5, or 20%. So what we're going to do is we're going to say, okay, 1/5 of that is going from C to P. So how would we do that? We'd say, okay, well, 7,120 divided by 5, 1/5. would be, and you can multiply it times 1/5, 1,424 is going to be out of C and being allocated to P. And then if we consider the amount from M allocated to P, we see that's going to be 25%, which of course is 1/4, 1/4. So 1/4 is going to be going from M to P. So last time we had 4080 divided by 4. 1/4 is 1020. It's going out of M and into P. So that's what we have here. If we take a look at our totals, then we're saying C had 7,120. We're going to take out 1/5, giving us 5,696. M had 4,080. We're taking out 1/4 to bring it down to 3,060. That 1/5 from P, that 1/4 from C, that 1/4 from M to P is 2,444. So we're going to have our same number here. The rent's the same. This is our new allocation. Now we're also going to be looking at the percentages and use those percentages for the utilities percent. So in other words, we're going to say, all right, well, what's the percentage? And I'm going to use this allocation of the rent to apply out the utilities. That's going to be our activity base, in other words. So we're going to say, all right, here's the 5,696 divided by the 11200. That's about 5086. And then here's the 3060 divided by the total 11200. That's about 27.32%. And then we have the 2444 divided by the total 11200. That's about 21.82%. Those, of course, adding up to 100%. We can then use those percentages to allocate out the utilities. So in other words, this is going to be the rent allocation. These are the percentages that we're going to be using to allocate out the utilities. So the utilities then are at 4,300. And we're going to take that 4,300 and use these percentages. 4,300 times 0.5086. There's rounding involved here, as we know, about 2,187. And this is a forecast, so we expect rounding. That's okay. 4,300, and this 4,300, by the way, is coming from there, times the 0.27.32, and that's going to be about this number, and so on and so forth. If we add these up, 1287 plus 1175 plus 938, we get the 4,300. So that's going to be our allocation. So we're going to take those two items and allocate them out in our projected income statement or forecasted income statement. Then we're going to have the share of office department expenses. That's going to be this item that we're going to need to then allocate to office department expenses. We're going to be using sales in order to do that. Now again, remember that sales has nothing to do with really the office department expenses, but we think that the ratio of sales is an appropriate activity base for us to use in order to apply out the office department expenses. So to do that, we're going to take the current year sales. So this is the sales amounts that we just pulled over, and we're going to record the percentages related to them. In other words, 183,600 divided by the 360,800. That's going to be about 50.9%. If we take the 124,200 divided by the 368, we get about the 34.4%, and so on. These will be our percentages. They add up, of course, to 100%. Then we're going to take the total current expenses. That was at the prior year expenses. That's going to be the 16,000. That's what we had last year, our 16,000. And we said that they're going to be increased by 7,200. That's what we're projecting to happen next year. So in total, it's going to go up by another 7,200. So we're going to start here. Our total is here. And then we just simply break this number out in accordance with our percentages. So we know what the total is, 16 plus the 7,002 for 23,200. 23,200 times the 0.509 is about 11,808, and again, this 50.9 is rounded, so it's not exact right there. And then we got the 23,200 times 0.344 is about this number here, and again, there's rounding difference. in these numbers. So again, it's a projection. That's okay. So we have those numbers that we can then apply out. That's going to be the share of office department. Then we got the total allocated expenses, which is this plus this plus this all the way across for CMP department and the total. That'll give us the total expenses. The total expenses being the direct expenses. So we've got the 24,126 plus the 19,689 and the allocated or indirect expenses for the 43,815, and then we'll get to the net income, that being the gross profit 93,636 minus the expenses of the 43,815 for a 49,821 on our net income. And again, that applies out all the way across CM and P and the total. In this presentation, we will take a look at a balanced scorecard approach to measure performance. When we consider a balanced scorecard approach, what we're trying to do is measure the performance of different divisions within an organization. As we consider the measurement of how different organizations are doing, we typically think of financial goals, financial perspectives, putting together financial reports of some type, responsibility accounting reports that will then show the performance of each division. And that's going to be very important. That's going to be one of the fundamental factors of what we put together. However, we might want to put together other things that are going to be involved rather than just the financial perspectives, because the financial perspectives often don't take into account all the things that are necessary within a department. So to effectively measure the performance of the department, we might want to put together some type of balancing scorecard. In other words, we're going to put together some groups of things that we think are important for a particular department, including the financial perspectives of it, and then we'll somehow balance those items so that we can come out with a measure of how each department is doing based on those things. Notice that as we do this, although we're not talking about financial data all the way through, we want to make this thing as transparent as possible. We want to be able to say each department manager knows what they're going to be measured on. We want to make sure the measurement is as fair as we can, as transparent as we can, so that when they go and they actually perform, they know what they're going to be, what they're expected to do, and what they're going to be measured on in terms of performance. One of the reasons that we measure based on the financial perspective so much is, of course, one, because revenue generation is going to be one of the major goals of the company. However, one reason revenue generation is such a major goal of the company, of companies in general, is because it is a really good indication typically of how companies do and how segments are doing within a company. Because obviously, if a company is doing well and they're regulating their costs well and they are generating revenue, those are good indicators that they are being run well and efficiently. So the financial perspective, the financial indicators that we use aren't just used simply because the revenue is the goal that we're shooting at. They also are very good indicators of the health of the company in many ways as well. But they're not the only indicators of the health of the company as well, and we want to take into consideration other indicators as well. As we consider the other big advantage note of the financial perspectives are that they're numeric. So that's the point of money in general, and us measuring things in terms of dollars. The dollars give us a measure of value, and that numeric value is really useful because we can obviously compare numbers to numbers, dollars to dollars. When we consider some of the other perspective, if we think of things like customer perspective and whatnot, a lot of times it gets a little bit more difficult for us to put a number to something as we can with financial perspectives. And that makes it more difficult to measure. Anything that is going to be subjective in terms of the measurement process is going to be different to measure across different people that have different opinions about different things, right? So as much as we can, even within these other areas, we're going to say, hey, I know this area is more subjective. I know that you can't break everything down to numbers, but as much as we can, we want to do that if it's applicable, if it's relevant to do so in a particular area. We want to do that. Why? Because that allows us to basically quantify this information. You could picture what's going to happen here. Basically, we have a vision that the company is going for. The ultimate vision that's going to be way out into the future is what we're shooting for. We typically have short-term goals in order to get to that vision, including the financial goals. One of the things we do not want to happen is that people take those short-term goals, like financial goals, and they sacrifice the long-term vision. For example, They sacrifice basically possibly the brand name or kind of the goodwill of the organization for short-term profits in order to meet short-term goals. That might help in the short term to meet certain goals, but it's going to be against the long-term vision. It's against what the shareholders typically would want, the owners of the organization, because they want the organization to be a long-term going concern typically. So sacrificing long-term going concern for short-term revenue at the expense of the name, of the goodwill of the organization or something like that would be something that would typically want to be avoided. One way you can try to look towards that long-term perspective is put together some type of balanced scorecard and say, hey, look, we're going to measure you based on this group of things that we think are more in alignment with the long-term perspective. Yes, the financial goals are included, but we have these other things involved as well. We'll obviously, to make this transparent, need to put some type of weighting on these different categories as well, so that people know exactly what they're going to be measured on, what the weight is between these different categories. These things will change, of course, from company to company, as company to company have different visions, different long-term visions, how they want to measure those long-term visions, what emphasis they want to put, what's more important based on different type of industries, where should their emphasis be put in different types of industries. It will change based on the industry that we are in. So this is just kind of some general categories that would be put in place to emphasize the fact that we need more items involved within the measuring process, especially for larger organizations. Many of this will change from company to company, but also there's a lot of standards at this point that are working from company to company. So although it's managerial accounting, it will change from company to company. We can also see what other companies are doing and say, how did they do that? How did they quantify that? And see if it's applicable to the company we're in as well. So here's some categories we could have. We can have the customer perspective, of course. We can measure things within the customer perspective. The internal processes, how are the internal processes doing? Measure those, the efficiency of those, the financial perspective, and the innovation and learning type of perspectives. Within these items, we might then put together some type of measurements that we could use in order to judge these different areas. And again, we want to quantify these measurements as much as possible to be as transparent as possible. For example, customer perspective, we might have customer satisfaction ratings. Now you might say customer satisfaction surveys. We probably have those too, and we'll get a lot of feedback in terms of text. We'll read through all that and see if there's anything that we can apply to it. But note that if we get the rating, that's going to be a way to quantify it. And that's going to be a lot easier for us to say, hey, this is how this department is doing based on customer satisfaction ratings as compared to some other company or department. And we can make that comparison a lot easier. Now, if there's stuff that's coming up in the text in surveys, then of course we might put that in a numerical format. We might say, hey, is this something that you would want? Say how much benefit this would be to you in a 1 to 10 kind of analysis. And that way we can try to, again, quantify it in some way, which is a little bit easier for us to do comparisons with if it's applicable. Number of new customers acquired. Again, we're trying to quantify it in some way. I mean, how many new customers do we have in this department compared to another? Percent of time deliveries, percent of on-time deliveries. And notice we have to use a percent here because, again, some departments might be bigger or smaller than another department. So we can't just use total on-time deliveries versus non-on-time delivery, right? We have to use some type of percent in case the departments aren't equal in size. Percent of sales from new producers, same kind of concept, that they might not be equal in size, so we would use the percentage. Time to fill orders, we can take this good old stopwatch and to say how long it takes to fill, or track in some format, how long does it take to fill an order. Percent of sales returned, again, we can think about how many sales are returned, and that would be an indication from the customer of how satisfied they are. Internal processes. So we're measuring the internal processes. We can have the defect rates. How often is there defectiveness in a certain department? And again, we can compare from department to department using a rate. We can have the cycle time. How long does it take to go through the processing cycle? We can have the product costs, of course, measuring the product costs, labor hours per order. How long does it take? We can, again, pull out the stopwatch and think about how long does it take per order to go through this process, and then refine down the processes. Note, again, everything is being broken down to numbers as much as possible so that we can basically do the comparison. Production days without an accident. So how long has it been without an accident? And then, of course, the financial perspective. We have obviously the financial data, the net income, the things that we're most focused on. And then we have our ratios, the ROI, return on investment. We have the sales growth. We can measure sales growth, cash flows. These are all things that obviously we have the financial data and we can see numerically. We have the residual income, the stock price. These are all financial indicators that we can be using. And then innovation or learning. So we want to think about the innovation and learning. And again, some categories that we could come up with in there would be employee satisfaction. So we can try to measure employee satisfaction in some way. Again, possibly numerically. We'll probably put together some numerical thing. How satisfied are you on a 1 to 5, 1 to 10 scale, and this, that, and the other type of category. Employee turnover. Measuring the employee turnover, how many employees are leaving, how often do they leave. We can look at those rates to do that, quantifying it. Dollars spent on training. How long does it take to train? What is the training costs? Are we spending time to make people happy within the training? What's the training look like? Number of new products. So we can take a look at the new products that are out there as an indication of innovation. Number of patents. Dollars spent on research.